Hey everybody, it's John King with Summit Funding, and it is Friday, the 7th of July. Thank you for joining me on this holiday week. Hope everybody had an absolutely wonderful 4th of July holiday. Hope you made it a long weekend, and for some of you, you're probably in the middle of a long week, 2 weekends that got extended into the middle of the week as well. But anyway, let's dive into the markets and what's going on in the mortgage world. Here's the deal. The mortgage market, the economy, the stock market, it's going through a transition. And think about transitions in life. Think about whether it's your transition from childhood to adulthood, which, the teenage years, quite a transition. You've got different signals that you're seeing. Your body is changing. Your voice is changing for some people. You've got a lot of things happening, and you're not really sure because some things make you feel like I'm still a child, and some things make you feel like you're still an adult. Maybe another type of a change is just the daily change we go through from daytime to nighttime. And it's twilight, and you're switching from, it's bright outside and beautiful day, and I got to wear my sunglasses to it's dark outside, and I need to put on my headlights. Well, you know that as you drive at night and you hit twilight, you've got some people that are still driving with their sunglasses on and their headlights off at the exact same time that somebody else is driving with their headlights on. And sometimes it has to do with what direction you're driving. So if you're driving west and heading into the sun, you're going to think it's lighter longer because you're staring into the sun. If you're driving east and you're heading away from the setting sun, you're going to think it's darker sooner and you're going to turn on your headlights sooner. And so it's the same time, you have the same amount of sunlight, but the direction you're facing, your perspective, the information that you're looking at changes the view of what you think is happening and what you should be doing at that exact time. That's exactly what's happening with the economy right now. We're in a huge shift between a market that had really, really high employment, strong jobs growth, and high inflation that we've seen really for the last 3 years since COVID really shut down the economy and then lit a fuse and made it take off like wildfire. And now we're shifting into kind of the next phase, which ultimately is going to bring a recession. The question is this transition going to be quick, or is it going to be slow and drawn out? And it kind of feels like it's slow and drawn out. I was talking to a couple of my students last week. You probably know I'm a professional coach also, so I coach other loan officers across the country. And I was telling my students last week, here we are halfway through 2023. And if we rewind 1 year, what do we think was going to happen as of right now? We expected to be through the transition. We expected this transition from high inflation, high rates to lower inflation being under control, and interest rates coming down and really heading into a recession by the time we hit the middle of 2023. And that is not the case. The employment numbers have remained super strong. Why does that matter? Because jobs mean income. Income means spending. Spending means inflation. And that's the formula the Fed is worried about. And so right now what we've got is we actually have another dynamic that I hadn't really thought about, but it makes a whole lot of sense. And that is homeowners who have super low interest rates. Yes, they're not selling their homes. We've talked about that ad nauseum during this weekly update, but those homeowners have super low monthly payments. So they bought their house years ago and they continued over the last decade to lower their interest rate and lower their monthly payment while their incomes kept going up. Every single year they'd get pay raises and they'd make more money. And that created a bigger gap between what they had to spend versus what they earned. And that's disposable income. Guess what? Even right now, there's a lot of disposable income. Even with high inflation, even with the price of eggs and groceries and gasoline being super high, the fact of the matter is you've got people with a lot of discretionary income because they have a super low house payment. It's one of the biggest benefits of being a homeowner. Everybody talks about the fact that you buy a house in order to gain appreciation. I've talked about the fact there's actually 3 reasons you buy a house, and it's appreciation, it's your forced savings account of paying down your principal, and it's your tax deduction. But there's a 4th thing that nobody's talking about, including me, which is you have a fixed housing payment that stays the same and over time actually typically goes down when you're able to refinance and get lower interest rates. And all of the homeowners right now over the last 10 years have continued to lower their housing expense. So even with inflation, even with everything costing more, the majority of homeowners have been able to absorb it. Why? Because their house payment is super, super low. Well, that means in a normal cycle, what we would see right now is we'd see the inflation causing a slowdown in jobs because people don't have money to spend on discretionary things. But these homeowners do, and they're spending a good amount of that money. And so it's the timing of this cycle is not playing out the way that everybody had expected. And so we're dealing with volatility during this transition. And the biggest thing that's being focused on right now is jobs. Why? Because the Federal Reserve has said very clearly that the outlook on jobs, how many jobs are created, how many jobs are lost, what the average wage growth is for people, how much you're making per year, your pay raises, is a critical factor for them to decide if inflation is actually going to be under control, because they don't want what happened in the 70s where we stopped prematurely in fighting inflation, and it ended up that inflation became semi-permanent throughout the 70s. And they don't want that issue. I don't want that issue. But what does that ultimately mean? What it ultimately means is we're going to deal with a lot of volatility. And this week and next week is going to be a perfect example. So there are two types of reports that come out that talk about jobs. The first report is a monthly report that comes out. It's called the Non-Farm Payroll Report, and it's from the Bureau of Labor Statistics within the federal government. And they publish that report once a month on the first Friday of the month. That report came out this morning. There's another report that comes out from a private company, ADP. You might have heard them because they do a lot of payroll. As a matter of fact, it's American Data Processing, or I don't know, something like that. Anyway, ADP gives a report every single week on Thursday. So ADP's report yesterday said jobs are up significantly, unemployment claims are down. That means that we're going to have a long duration of inflation if that report is actually accurate. Now, I'm not saying the report's inaccurate, probably the wrong way to say it, but if it continues going that direction, in other words, it's a sign that says, inflation's not under control and the Federal Reserve is going to continue to raise interest rates. Then comes today's report. Today's report is the monthly report, first Friday of the month, and it actually showed lower job growth than everybody expected. The first time in the last 14 months that the expectation of job growth was not hit. So that says, hey, wait a second, maybe things are starting to slow down. Maybe job growth isn't what we thought it was. Maybe we're turning the corner. The problem is it's the exact opposite signal that was given yesterday. So yesterday we saw interest rates jump up. So the report was issued an hour and a half ago. And as soon as the report came out, interest rates started falling. And then within a half hour, they started going back up again. And that was kind of crazy until I started thinking about it and saying the market doesn't know how to react. And that's the problem. It's that transition. It's that volatility I was talking about. It depends on what you look at. And next week is this up. Every month we get an update on the inflation numbers. Next Tuesday, we get the update on the inflation numbers. That's going to be very, very telling. But again, a single month does not tell a story. It's a pattern. Everybody's trying to figure out, is this the month that is the beginning of the shift, the beginning of the new pattern? That's what we're dealing with. That's the huge amount of volatility, because here's the bottom line. And if you've been listening this long, you're waiting and saying, John, what does it mean to rates? Rates are as high as they've been since November of last year. If you've been following me since then, you heard me talk about October being the highest interest rates we had. In November, they started coming down because inflation started showing signs of dropping. That was the first change. That was the first sign or signal that things were starting to change. And we had multiple months in a row of inflation coming down. And then the Federal Reserve said earlier this year, inflation's not our only concern, jobs are. And I just spent the last few minutes explaining to you why jobs are a major concern. And so now what we're dealing with is more questions about what's going to happen with the pattern of jobs. And it's got interest rates up at the 6.9 to 7.25% range. That's the highest we've seen since late October, early November. Really, it's the highest we've seen in years. And the question becomes, did we hit a peak again? Is this jobs number going to show that things are going to start coming back down? I don't think they're going to go back down much lower than 6%. I think we're stuck maybe for the next 9 to 12 months in that range of 5.75 to 6% at the low end to 7 to 7.25% at the high end. That's the range that I think we're stuck in. But we're at the highest end of that range. And there's some people saying we're going to be at 8% by the end of the month. The jobs report today tells another story. It says maybe things are going to pull back a little bit. The Federal Reserve's meeting at the end of the month. They're going to be digesting all of these numbers, and we're all trying to read the tea leaves to figure out what's the Fed going to do. All right, well, I want to transition into something totally different, which is I want to give a little bit more detail and get you super, super excited about the new Golden Opportunities Down Payment Assistance Program that I brought up last week. So the Golden Opportunities Program will allow people to use down payment assistance down to a 620 credit score. It's only available on FHA, VA, and USDA loans. So it's not something that we can do for a conventional loan. It's really designed for the lower credit scores that are not being served right now. The challenge is a lot of people with a lower credit score, they have that lower score because they have a lot of debts. And that's not always the reason, but that's a big component of it. And so these people who have a lot of debt, their debt to income ratio is high. So there's a double whammy. They have a lower credit score, lower than the 640 or 660 or 680 that's required for most down payment assistance programs, but they also have a higher debt to income ratio. Well, this Golden Opportunities Program solves both of those problems. We'll be able to go down to a 620 credit score, and instead of capping you at 45% of your income towards your debts, we're able to spend 55% of your income towards your debts. Now, some people might say, John, that's a horrible idea. Why do you want people with lower credit score to spend more of their income towards their bills? Because most of the time, the clients that have that high of a debt to income ratio have another job, or they have a family member that's helping them, or a roommate that's helping them. We just can't count that income in the qualification. And so this new program is, I can't count that other person's income in the qualification unless they're on the loan, but it allows me to stretch the debt to income ratio a little bit for those people who truly can afford it. They just don't show it on paper. All right, the final thing I want to talk about today, California Housing Finance Authority Administration, authority, and the California Dream for All program. So I've been saying all along, Dream for All is coming back out in the fiscal year that started on July 1st. That is 100% true. But I got a little bit of a shocker on an email that I saw late last week that talked about the amount of money. So I had said that it was going to be a repeat, and everything I had read said it was going to be a repeat of the $300 million that was allocated last year that ran out in March in 8 business days. Well, guess what? It's not even 300 million. It's going to be 200 million based on what Cal HFA announced. So everything else I was reading was kind of reading through the legislature and the budget and trying to read all of the provisions and how things add up. And clearly I missed something. I'm human. So I thought it was an exact repeat of the $300 million that was allocated, but it is not. It is $200 million. So Dream for All is going to be another great opportunity, but it's going to go even faster. I'm hopeful they're going to change some of the guidelines. I'm hopeful they're going to limit the money that goes to each person a little bit so it can stretch out and go to more people. But I don't know. We won't know that until they release the funds. But the bottom line is Dream for All is coming back. And if you have any desire to take advantage of it, you need to be talking to me now. Because otherwise, if you wait too long, you're going to not be ready when the moment the money comes out. And then you're going to be wondering, why did I miss it? Because you weren't prepared. Thanks so much for listening to me. Hope you have a wonderful weekend. And don't forget, I do mortgages. So if you know anybody who's looking to purchase or refinance, because here's the deal. I've helped 3 or 4 people refinance recently out of 3.25% or 2.75% rates into 6.5% or 7% rates. Horrible of me, huh? Not really, because I'm saving them $1,000 a month. Their home equity lines of credit rates have skyrocketed, and some people's rates are pushing 9 and 10%. Credit card debt in the United States is at an all-time high, and consolidating that credit card debt, even if you're getting it at a 6.5% or 7% interest rate, it's tax deductible. It's way cheaper than what you're spending right now in monthly payment. And it makes it easier down the road to get your credit score up, because this high credit card debt is causing credit scores to drop, which means you're going to be in a harder position to refinance when rates fall versus bite the bullet now, Do the refinance now, consolidate your debt, lower your overall monthly payments, build yourself up a rainy day fund, and put yourself in a position to qualify for a better mortgage once interest rates come down. Thanks for listening and have a wonderful day. Bye-bye.